Good afternoon. How is everyone doing? Thank you for attending the session today. If you are here, if you can see me okay, you can hear me okay, you can see the screen, let me know, put it into the chat. Hey guys, how are you all doing? Good stuff. Hey Chris, how are you doing? Give it a couple of minutes before we get started. I'm doing well. Let me just do this. All right. Thanks, Alan. Sounding good. I'm doing well. I had a good trade on the Aussie dollar this morning with the interest rate position, so I'm quite happy with that. Hey Kelvin, how are you doing? All right, so as usual, my standard request, let me know, put it into the chat, put it into the question section or the chat. Let me know where you're joining me from. I'll give it a couple of minutes before we get on our way. Today we are with IC Markets webinar going through the trading strategy series on how does the martingale strategy work. If you can, let me know as well. Do you use the martingale strategy? Right, so two things you have to let me know here before we get started. Where are you joining me from? And also whether you use the martingale strategy. Fantastic. We do have a couple of people, well, quite a number of you guys joining us from Australia right in the evening right now. Hey Desiree, how you doing? Too scared to use. All right, it's quite interesting. There are it is a bit of a scary situation strategy to use, but if you manage it well, you have a different way, or tweak the way you approach it, could be quite useful as well. All right. Hey Panjak. Hey Akimi. Fantastic. All right, it's always good. Also let me know, right, if you guys, I see a lot of familiar names, you're all learning new strategies, learning new methods. If you do learn the strategy or you approach it, right, if you have any questions, you know where to reach out to me, right? Same place all the time, so let me know. Martingale and Greed EA, yep, that's great. All right, so let's get started. As we get everyone streaming in, again, thank you all for attending the session. I will be today sharing with you IC Markets webinar in terms of how does the martingale strategy work. All right, so again, if you have any questions at any point in time, please feel free to put it into the chat, put it into the questions section. Let me know. Even while I'm mid-speech, just type it in. I'll check it out and then I'll answer your questions as it comes along. All right. So with that, let me just arrange a couple of stuff around. Okay. So as usual, before any webinar, any sessions, a quick disclaimer is that any information contained in this webinar should not be construed as advice and is presented as educational material only. International Capital Markets, IC Markets Private Limited, has not considered your objectives, financial situation, and needs, and you should consider its appropriateness for your circumstances. The contents of this webinar and any accompanying material are not intended to be a solicitation of funds or a recommendation to trade a financial product. What it means is that I might be a bit less likely this time around, but I might be sharing with you some possible trade setups, my views and opinions of the markets, and how I would apply different strategies. If you are going to apply a strategy, make sure you do your due diligence. Make sure you check, especially in this case, especially the martingale strategy and system. Make sure you check your leverage, check your margins, because check your bank, or not the bank, your account equity and balance as well, because this part this strategy is going to be crucial that you check those key criteria. All right. Akimi, I will be looking at the anti-martingale as well. All right, so that will come in towards the end of the session. So that will be part of it as well. All right. So again, any questions, let me know. Let's get started. Couple of things to get through today. What is the martingale strategy? Good to see that quite a number of you do use it. All right, quite a number of you do use it. I hope you're using it effectively. All right, I hope you're using it effectively, not in the sense of you know, the negative way or the way of short-term gains and long-term destructions, right? So we'll share with you what is the martingale strategy, how or does it work, and how does it work. I'll give you some examples of a martingale strategy, and then also the limitations of the strategy as well. Okay, so again, hey there, Jamilu, how are you doing? Again, I can tell you that this is not a strategy that I deploy. I wouldn't even say frequently. I wouldn't even say occasionally. This will be something that I know, right? I know how it works. I know that how to use it, but it's not something that I really like to deploy, just because it's high risk. All right, I'm a bit cautious about. I have been actually very cautious about trying to teach you guys this, because you know, if you deploy it incorrectly, it can be very dangerous. It can be very risky. There are ways to minimize that risk. There are ways to manage it. You know, so I just want to use this session to really, you know, guide you guys along that path, rather than randomly buying or selling and then, you know, running into ruins that way. Okay, so you can sense my usual. I'm usually going off the charts, ranting about everything. Going to take it very carefully this time around, because you know, deployed incorrectly could be very dangerous, but also if you deploy it correctly can be quite beneficial, right? All depends on the strategy that you use in addition to the martingale strategy. Not just martingale, but the strategy you use in addition to that martingale strategy. Hey Simon, how are you doing? Thanks for joining. I see that you've been commenting a lot of my analysis. Really appreciate that. All right, so introducing your host, myself. I think most of you know me already, so I'll breeze through this quite quickly. I'm one of the external analysts, investment analysts here at the Everest Fortune Group, award-winning research team here. We provide a lot of analysis on a day-to-day basis. I have previously managed a multi-million-dollar fund. I can tell you that I've never used the martingale strategy on that fund, but what I do is how I trade. I look at fundamentals first. I do a lot of fundamental analysis, economics analysis first, and then look into the charts to determine the timing to get into a trade. All right, so for me, I look at fundamentals, overall view, where should price be heading. For example, today's Aussie interest rates decision, surprising decision from the RBA. What they did was they increased rates by 25 basis points instead of the expected 50, and then what we saw was a quick drop in the Aussie dollar, and then the big push back up because of the dollar weakness. But right now, if you are looking at the charts, I'm not looking at the charts right now. If you are looking at the charts, it has retraced, shot up during the day. It's retracing back down now again. Okay, so that's how I look at it. I do longer term views in terms of economics, shorter term views in terms of the charts, and then I do intraday trading, intra to long to over a couple of days kind of trading. All right, so again, if you have any questions about trading in general, please feel free to ask. I will give you my 2-3 cents worth of opinions. I hope it helps you with your trading, overall trading journey as well. Okay, hey John, how are you doing? Glad you can join us from the UK. So what is the martingale strategy? Basically, it is a theory, or it is a method, a system, a strategy based on increasing amounts, right? Entering, let me see how to do this. Okay, it is based on the theory of increasing amounts, even if value is falling, right? With the expectation of a future increase. Okay, so key things here to note is that you are trading more, you're trading in terms, or you're investing in terms of an increasing amount, even if value or price is falling, with the expectation of a future increase. Many ways to look at this. Expectation could be well described as a guess, right? As a guess, as a gamble. Increasing amounts as you're betting more, you're increasing your trade size, even as price is falling. So what happens in basic schematics is that you might have bought at this point, right? Price might have been going up. You bought thinking that it's going to go higher, it drops. It bounces and it drops lower. As it drops, you look to buy again at a bigger amount. So this is usually ×2. And then it continues going down. And then you buy again. This is ×2 of the previous. So this is ×4. And then maybe it bounces around, sits in the consolidation before dropping lower again. And then you're buying ×2 of the previous, which is now ×8. And then on and on and on, hoping or expecting or gambling that price will go back up. Okay, so in basic terms, that's a schematic of the martingale strategy. What you're doing is you're averaging down to avoid losses, all right, rather than seeking profits. So you're avoiding a loss once it comes back up by about halfway. That's the calculation where you have your break even point, and then you close out usually for a small profit, just because you're happy to get out of a trade, right? You're going to close off all this by buying trades, closing everything out, and then getting out with a small profit, just happy not to lose money. Not the, you guys have attended all my sessions before, not something that I would usually, or I definitely don't encourage, right? Loss is a part of trading. You win some, you lose some. Often with a good trading strategy, you might end up losing more trades than you win. But with a good risk to reward, you could also end up, despite losing more trades than you win, still being profitable. Okay, so there's one issue or one thing to consider. Martingale strategy, averaging down to avoid losses, not something that you should do on purpose, I would say. This is a bit of a recovery method to avoid losses rather than seeking profits. Is extremely, right? So initially I only had it as a risky method. I added in the word extremely risky method of investing or trading. All right. Any advice, any advice on flipping accounts? What do you mean by flipping accounts? Elaborate on that a little bit, and I'll see if I can give you any advice on that. Hey, Cher. Hey, from the UK. All right. So an example, right? Aside from trading, let's look at it simply as an example. If you're flipping a coin, right? If I had a coin here, I'll flip it. If you're flipping a coin, you're engaging in a game of coin flipping, and probability, it's, unless you're so good at it, stands right in the middle. It's either going to be heads or tails. It's 50-50, right? You enter a trade, you're either going to win or you're going to lose. In a coin flip, you're either going to get heads or you're going to get tails. So you start with a bet or wager of $1. Equal probability, 50-50, right? 50-50. If, let's say, now you're betting that it's going to be heads and it comes out to be tails, you lose. What happens on the next round? You bet twice as much, so you double the wager, right? Because we know it's a 50-50 outcome. If this time you get heads, the next time again it's 50-50. You have lost the first one. Second one, you bet $2. If you win that, you make $1, right? You double down to try to make $1. If you lose 2 times in a row, The next time you're going to bet $4, the next time you're going to bet $8, the next time you're going to bet $16. You're just going to keep doubling up, right? So as long as you stick with the same call, you just keep going, keep betting on heads, keep betting on heads. If it comes out tails, I'll just keep calling for heads. You will eventually, given an infinite amount of money, see the coin land in your favor. We know that it's 50-50. Statistically, it is 50-50. But you could have the first 50 tosses of the coin being tails and the next 50 being heads. So you just need to be able to, in this case, sustain through that first 50 tails, right? So that's why we say with an infinite amount of money, if you keep doubling up and doubling up and doubling up, you have one win that could cover all your losses, recoup all your losses plus $1, right? So I hope that it's quite evident to everyone attending right now and listening in right now is that yes, you hope that your guess is right before you run out of money. You're spot on there, Simon. So that's why it says infinite amount of money. Okay. Is grid and martingale the same? Because martingale means exactly doubling each time, whilst I use a multiplier 1.3 instead of 2. Is it still considered? Yes, so got a question there from Desiree about the difference between grid and martingale. It is very similar. I would say that it's almost the same. Even if you don't double up, even if you use a smaller multiple, still that same idea. The difference between grid and martingale is that grid actually considers they actually set buying orders below levels, right? So they actually look for, in this case, so on a bit of a side track, looking at grids, I'm getting quite good at scribbling with the mouse, right? Looking at the grid method, basically as it drops, right, you're setting buy orders here below key support levels. You're looking for buy orders, so you're actually looking to get in as it bounces, right? And then it goes down, you look for another buy order again, and then you just keep looking for buy orders. It's set at a percentage, so usually the grid is split into different percentages. Sometimes, and quite often, it's based on the Fibonacci levels, and then it jumps into those trades just so that when it bounces back up, it calculates where the break even and some profit levels are. Okay, there are also ways that you can use grid as a reverse, which I think very early on someone said, a anti-martingale or reverse martingale. That is what I'll be sharing with you later on as well, how you can use that in terms of not stacking in a losing position, but stacking in a winning position. Is martingale mainly used for scalping? No, it's actually not so much for scalping. It's more a recovery method. It's more a longer term. What you find is that it ends up becoming a bit of a longer term scenario, right? Unless, of course, you use it in the 1 minute or in the 5 minute time frame, then it becomes very quick. But overall, in the longer term time frame, it does spread out into quite a long-term scenario, right? So just a visual of what we're just talking about here in terms of the coin flipping example. Imagine the first one, you lose one coin, right? You flip the coin once, you flip $1, you lost it. The next time you bet 2. If you lose that again, the next time you bet 4. And then on the 4th round, you've bet 8. And then you win. So you got 1, 2, 3, 4, 5, 6, 7. You've lost 7 coins. The 4th round, you've got 8 coins. So all in all, you're going to be plus 1. Okay, so you can see that it's not a strategy by doing a martingale or doubling down. It's not a strategy where you're looking to make massive returns, right? It's a strategy that you're trying to cut back on your losses or not realize the loss and make a little small profit. Okay, that's one of the ideas there. In terms of looking at it on a chart, all right, looking at this on the chart, And like Lo Lee asked, right, is this a short-term or long-term scalping method? I'll share with you here. This is the euro dollar, right? I've lost the symbol, but this is the euro dollar here. And what you'll notice is that, let's say it's been going up, and at that point at the top, you're expecting it to go up further. It doesn't, right? You're expecting to go up further. You bought one lot there, right at that point, and then it starts turning back down. Typically, what we'll say is you would have your stop loss maybe at that level there, right? But because as some of, I'm not saying you guys, maybe some other traders would have a bad habit to say, hey, I don't want to realize this loss. I think that it's going to bounce back, right? Markets are in a cyclical scenarios. We're looking for it to bounce back. Reason why a lot of people think that or believe martingale works strongly is because of that scenario. They think everything is going to go up and down, so all we have to do is wait for it to bounce towards the upside. Okay, so in this case, you buy one lot, you would have normally have your stop loss there. What happens is you take away that stop loss, and then it drops further. As it drops, once it bounces back up, what would you do at that point? You probably think, hey, if I buy now, if I buy twice as much or buy two lots, all it needs to do is come back up a little bit. I can close off everything at break even. Great, no loss, small profit, or break even levels, right? So some traders doing a martingale would buy at about that point there, and then it drops further. Again, no stop loss. You've already gone to the point where you're not willing to accept any losses, so you've foregone putting in a stop loss, and then it drops further. You're sitting there worrying, stressing out. Once it looks like it's going to bounce, you buy 4 lots, right? You buy double of the previous. You buy 4 lots at that point, and then expecting it to turn back up because that looks like a big strong push. You buy here expecting that move up, but it doesn't. It sits right across before dropping again. As it drops, what happens? You look for it to bounce, or you look for it to find a support there, you know, near that 101 level. You think that's going to bounce, you buy double of the previous 8 lots in this case, expecting a bounce. Doesn't happen, right? Again, it drops, it breaks below that support level, and then it drops further and further, and then at that point, at that 0.99 level here, you start thinking, hey, maybe it's going to bounce now. Buy 16 lots, double of the previous, and then you're sitting there waiting and hoping that, you know, price is going to bounce back up so that you can close out. Okay, in this case, what you should notice in this chart is that you'd have bought 1, 2, that's 3, plus 4 is 7, plus 8 is 15, plus 6, right? So you bought a lot. You bought 31 trades or 31 lots towards as it's dropping towards the downside. You've just kept buying and buying, and you can see that from that point all the way down, it's dropped to 457 pips towards the downside. It dropped 400. What's that logo there? Jamila put up a logo there. Can't see it, not very clear. All right, it's dropped 457 pips towards the downside at that point. Or, you know, 2 things to consider is what's the amount of money you have in your trading account, right? Can it sustain any further downside? Can it sustain another buying? Because if it does drop further, right, at that point you're gonna have to buy 32 lots, right? Do you have the balance, account balance available, and do you have the margin available to buy more? Okay, so it becomes very dangerous. You know, it comes to the point where that's why we say infinite amount of money. Drop 457 pips at 16 lots buy. What you need to happen is for price to move up by 230 pips to get to your break even level. right? Just an estimate. I did some rough calculation. That's your break-even level at 230 pips. What happens? This was in August, right? This was in August, I think 11th. August 11th was here. At 24th, 23rd of August, you have bought your 16 lots. What happens is you sit there and you wait, because you probably might not be able to buy more, and wait. You can see that price does drop a little bit further below that point, right? So it does drop a little bit further below that point. Might have bought, and then only in the 12th of September, price actually pushes back up above your break-even point. I can't draw a straight line, right? Breaks up above your, well, actually after the 12th, above your break-even point towards that 298 pips. Okay, so what I want to highlight here is that account balance, right? When you, how many lots can you buy? Can you keep buying towards the downside? And whether you got the margin to keep buying, and also understanding that if you get into this situation, what happens is you're holding on to a trade that, or holding on to multiple trades that you've started since early or mid-August all the way through to mid-September, just to break even. Just to break even. Okay, does it go all the way back up? We all know this is the euro dollar. Didn't go all the way back up. It actually does come crashing back down again. So again, this is one example, or this is the typical example of how a martingale works. You don't want to realize the loss on this trades, or well, typically you don't want to realize the loss on the first trade, and then it just snowballs. You get a second, third, fourth, fifth trade, and you sit there waiting and hoping. Okay, I hope that you guys realize that it's not the best situation to be in. I've just done a one lot round number calculation here, but it also applies even if you did 0.1, you know, you still double it, and it still becomes quite a sizable number, quite a sizable trading size. Okay, so just be extra careful there. So despite what I've just shared with you, does it work? Does it work? We got everyone in the session right now. Put it into the chat. What do you think? All right, despite what I've just shared with you here, or in spite of what I just shared with you here, personal experience, your own feel and gut feel, what do you think? Does the martingale strategy work? Put it into the chat. It works 30% of the time. How do you get to the number of 30%? Yes, it does work, but you need to understand and manage the risk. Definitely, Chris. Jamilio says no. Neil says yes. Lorian says yes. It works well in the range. Hey, Desiree just, it almost looks like Desiree saw my slides beforehand. It does work well in the range. It works well 99% of the time. Tilt it and it blows up your account. It's a very risky. It is a very risky system. It is very scary. It can work well. Actually, I'll add on to what Brandon said, that it works well 99% of the time. It does work well a high percentage of the time, depending on your account size. But the one time it doesn't work, it blows up your account, right? One time it doesn't work, it blows up your account. For me, I would rather look to say, hey, I bought one lot there. It's gone down, hit my stop loss. Straight away, I'm going to flip. Right? I'm going to flip my ideas. I'm going to find a reason, a fundamental reason why it's trading towards the downside. It's broken a support level. Can it continue down? Then I'll be selling it down towards the downside. I'll be selling it all the way down. Okay, so a little bit of a different approach there. So does it work? You guys have a bit of a mixed answers. Most of you did say that it does work. It does work. It's a very popular strategy, especially in the FX markets, right? Some people do try it in the stock markets, but if you see a stock dropping, there must be a reason why it's dropping, and stocks can get to zero, although possibly A bit unlikely, but it can drop to zero, so it's something to be very extra careful of. But currencies doesn't drop to zero, right? You don't see a currency go to zero, and that's why it's a very popular strategy in FX markets. But again, that line comes up. There we go. For this method to work, you should have infinite money, because the money in your pocket is always going to be less than the chance that the next trade is a loser or that price continues to go against you. This applies to what I've always told people or other people that I've coached, is that the only time it reverses is when you run out of money to sustain that martingale, right? The only time, right? If I come back to this chart, the only time it starts reversing is when it breaks down. You can't buy anymore, hit your margin, you hit a margin call already, closed out your account, and then it starts reversing, and you go, oh, next time I should have had more money in there, right? So just bear in mind, it is a popular strategy. What you normally would see is that if someone shows you a trading strategy that has a high win rate, most likely you want to say, hey, can you show me if there's any open trades at that point, because it could be a martingale strategy. Okay, why would you buy if the trade is going the wrong way? Analysis first, get out if wrong. Exactly spot on there, Simon. That's why one of the first few slides say it's a way that some traders adopt to avoid realizing a loss. Okay, but when we start thinking about some examples of martingale strategies, like Desiree said, right, it works well in a range. Okay, I will tell you that you're not going to get all your analysis right. You're not going to get all your trades right. There will be times where you get faked out by the markets, you get into a trade wrong, but you look for when to deploy, when could you think about deploying this, is that two things to consider, right? Is the trend. When to deploy a martingale is when you consider the trend, and also when are you going to cut the strategy? When are you going to cut out the strategy and say, hey, I'm not going to martingale this anymore, I'm going to accept that loss? I can tell you that the textbook method, they say that's 5 levels, right? You have to buy 5 times or sell 5 times before you start thinking about cutting. Say 2, at the most 3 times you have to start cutting out already, right? Because if not, the risk is too big. It's not worth that kind of risk, and it's going to throw the whole account totally into disarray. So in this case, we can say, hey, we got a support level here, it's gone up, it's hit a resistance level there, price has come back down and it breaks. It looks like, some of you might be looking, as it breaks towards the upside, you say, it's breaking that resistance level, can I buy? You get into one trade and you bought there. Okay, we know it's a bit of a ranging scenario. Once you buy, it turns back down. You've removed your stop loss. And then you say it finds a support level there. As it bounces back up, you buy 2 lots. You've doubled up, you bought 2 lots. You can see that it bounces back up. More than halfway, you would have closed out those 2 trades, got out. I would say that you'd be lucky to have got out of that trade, so that you made a little bit of money, or you got out at break even. Then what happens is it comes back down again. You've closed out your trade there, right? It comes back down, it bounces back up. You start thinking, oh, 2 big candles pushing towards the upside. You get excited, you buy in again, 1 lot, and then what happens next? It drops. All right, it drops. It forms a bit of a reversal pattern there. As it breaks towards the upside, you look to buy, and then it goes back up, break even, you close out. You would actually have made some money there because you bought 2 lots, pushing up towards the first lot break even. This one was making 2 lots, you have made some money there again. As it drops, you wouldn't do anything, right? As it bounces back up, you start thinking, ooh, can I buy here? As it breaks above those points, you buy 1 lot. As we know what happens, it turns back down, it finds the support level, you buy it at the support, whether it's bouncing off here or bouncing off here. You buy 2 lots, and then it reverses back up. You would have closed out at break even or back up again. Okay, so back up to near that resistance level again there. So does it work? Does a martingale work? Yes, it can work. I would say always pay attention to the trend, right? Especially in a ranging scenario, it works. It doesn't work in a big downward trend. It doesn't work or it takes a long time to play out in a big downward trend. Okay, so look at a trend and also understand when you need to close out. I wouldn't go for more than 2 open trades at a time for that one pair. So I wouldn't go like, okay, I'll buy there, and then buy there again, because what happens is that when you start adding on more, most likely price is going to break below that support, and then you just have to keep stacking and adding more. Because once you get to more than 2 trades, the psychology is that you wouldn't want to close out. It's almost like a sunk cost fallacy already. I've got so much money into this, or I've got so many trades into this, I've got 3 lots losing money, I don't want to close out. You just keep adding on to it. So it becomes a terrible hole that you have dug into. Okay, so trend in a range, I'll be looking, if you make a mistake, try not to make that mistake, but add on to your strategy. If you make that mistake, it's one way of recovery, but I wouldn't add too many trades. I'll look at 2 trades at the most, or 3 at the very, very most. All right, so far, any questions? Are you guys catching it all right? All good? Fantastic, thanks for that, Simon. All right, so you can use it in the trending scenario, in a ranging scenario. Trending scenarios are very tricky because it could continue on like we saw on the euro for a month before you get into a break-even scenario. And then a reverse, or I say the anti-martingale, right? The reverse martingale or the anti-martingale is that you don't add on to it's not that you're adding on to a losing position, you're adding on to a winning position, right? And in this case, it might be a little bit different to what you guys might have read online or might be deploying in terms of a EA, but this is how I would approach. I don't like to use the word reverse martingale. I would prefer to say it's a stacking of trades, right? A stacking of trades where price has come down, hit that support level, and then as it bounces up, you're saying, hey, bouncing off a support, can I buy? Right? As you look to buy at that point, 1 lot goes up, finds a consolidation, breaks lower, turns back up, right? So you're looking at this as a long-term trade to push up. You might find a bit of a good support level consolidation area there. As it bounces off, you look to buy again, right? You look to buy again. I would say you would buy at half the size, right? You buy at half the size. You never buy double the amount, right? You never buy double the amount because again, it's all about margin. And if it goes against you, you buy at half the size. In this case, the stop loss for this trade would be below the support level. The stop loss on this trade will be back at that same level as well, right? So we'll move the stop loss up just to protect the first trade and to take on or to try and maximize on the move if another trade pushing up. Then what happens as price goes up, breaks above, you can see that point there, breaks above that resistance level, you again look to buy at half the lot from previous. So actually should be 0.25. Yeah, it should be 0.25 there, half the lot. So this is, take that away, right? Half the lot towards upside. Again, stop loss was there. Both that stop losses will apply, or the 3 stop losses there will apply below that support level. And then as price moves up and it breaks above that next resistance level, you can see resistance level there, breaks above, you look to buy again. Again, at that point, you have 4 stop losses below that support level now. All right, and you can see right again after that, bounces, tests the support, bounces back up, comes down, close out all your trades at that point. This one would be at break even, right? Almost at break even, or lost a little bit. This one would be at 150, so it's not minus, it's plus 150. This is plus 238, and then this would be a plus 362. Right? I think it all adds up to about 750 or 700 and something there, 750 actually. All right, so then you would have 3 trades making you 750 in total, 1 trade at break even or a small loss. That's how I would approach this as a reverse martingale, or stacking the trades rather than putting it all, trying to find or trying to buy into a downtrend. A lot nicer to trade this way, a lot safer to trade this way, because every time it moves up, you're protecting your profits rather than jumping into more losses. This is a system I use with trend trading. Yes, very good, John. This is also something similar to the Davos boxes that I was sharing with you guys the last time around. You can also use this as another way to add on to your trades, or to add on to maximize that profit. Okay, so again, remember, let me just scroll back up a couple, that, and clear this out a little bit, it's just got a bit too messy. Okay, remember that when you're looking at doing a martingale, 2 things: trend and when to cut the strategy, right? And also I'll add in one more, is that it also considers your risk to reward, right? If you have a good RR in terms of like a 1:1 kind of, usually your strategy has a 1:1 risk reward, then sometimes you might be able to take on a little bit more of that risk to jump into those trades, like in this case, that 1:1 towards the upside, about there, so when you're looking at a 1:1, you'll be able to take on a little bit more risk, understanding that you could actually, one move back up, you could recover it, but I wouldn't do too many levels, 2 at the most 3. All right, any questions there on the reverse martingale, the anti-martingale, or what I call a stacking of trades? No questions. Okay, very similar to the grid method. I know grid method, especially the grid EA, is a very popular EA now that a lot of people are deploying. Just make sure you understand it, where it's being applied in terms of the different trending scenarios and what kind of time frames. Okay, usually I see grid systems being applied in small time frames, just within the day, quick moves. As it retraces or it spikes out, you look for the big retracement back down again. Okay, so what are the limitations of the martingale strategy? I'm pretty sure you all know. I've been harping on about it for the last almost 1 hour now. I'm pretty sure you all know what the limitations are, right? Amounts invested can reach huge proportions after a few transactions. That's why I would always say that few transactions should be less than 3, right? Just so that it doesn't become overly uncontrolled. It becomes less of a huge proportion. Right? If the trader runs out of funds and exits the trade, the losses faced can be disastrous. Again, when does this usually happen? When does the trade swing back? It's usually when you are not looking, or when you've run out of trades or run out of profit or money on your account, run out of funds. Okay, and then lastly, the risk to reward ratio is not reasonable. Right? Remember the coin strategy, the coin example. You're risking 8 coins to make 7 back just so that you got 1 profit. You're risking 8 to make 1. Right? It's not a good risk to reward strategy. High amounts are spent with every loss until a win, and the final profit is usually only equal to the initial bet or a little bit more. Okay, so those are the limitations. What I want to do next, right? We come to the end of the slides, but what I want to do next is to actually show you here on the charts. In this case, Bitcoin, right? I know usually I get questions about applying to the cryptocurrencies. Can this work on cryptocurrencies? It could as well. You can see that we have a bit of a range at this point. Okay, so you can see right there, we've got a bit of a range there. And right at the bottom, right at the bottom here. And then 1 point right in the middle at about there. Okay, so if we're just looking at this, we've seen it hit, bounce, break above, and come back up. So just very simple schematics for now. What you would be looking at, if you were looking to enter trades, as it breaks out towards this point, you're probably looking to buy, right? Let's say you buy 1 lot there. And then what happens? It reverses back against you, right? It reverses back against you. You might not have your stop loss, or might have removed your stop loss, not willing to take on that risk. As it finds there's a bit of a support there and it bounces off that support, what happens is that you end up buying again at that point, but you would have bought 2. Okay, and then it pushes back up. You would have closed out your trade, made money, made a little bit of profit as well because you bought 2 towards the upside. One common question I always get from people as I share with them about, applying this strategy is, do you always have to do twice as much? Do you always have to apply 2 times? In this case, yes, you do, because what you're trying to take advantage of is that it doesn't go all the way. It just have to go a little bit towards the upside. You can actually close out both trades for a small profit. Okay, so as it pushes up, in this case, it works very nicely. As it goes up, let's say that as it shoots up, you've closed off these 2 trades, and for the second time, you think that you're going to buy there, and then it reverses strongly towards the downside. Again, not a good trading habit, but you didn't have a stop loss there. What happens is you would buy again at that support level, stop loss below because you've anticipated this support level. And then as it comes back up, you would have closed out both these 2 trades. As it hits that level, this one almost small loss, good reward there on the second buyout, 2 lots at that point there. Okay, what happens is that it doesn't break above, so you don't have a trade. Third time, it breaks strongly, so strongly that you think it's going to break above that next resistance level. Again, you buy at that point, and then it reverses against you. Right? It's almost like a story where you see it in a trending scenario there. It reverses against you. Typically, stop loss level there, but in this case, you wouldn't want to accept that loss. Then you would buy again at that support level. As it hits and bounces, you can also see a bit of an interim level there. So you're looking to buy as it bounces off this point. Halfway, you would have closed out these 2 trades at a bit of a recovery level, right? At a break-even level as it moves halfway up. again, this point here, you would be looking as it breaks above. In this case, that's where the heartache happens, because you buy there, it comes all the way down. You would think you were thinking to buy lower, it doesn't, it comes back up. If you caught a buy here, you would have broke even. If not, then you would have seen it come back up. You sat through a lot of pain before seeing it bounce back up again. Okay, so in this way, what we're looking at, it does work in that ranging scenario. It does work in that ranging scenario, looking at Bitcoin here within that range. But what if I actually did move the chart further down, right? Look at that. What if you bought at that point? Where is it? Okay. What if you bought at that point up there? As you see it pushing towards the upside, you buy there. Next moment, your stop loss is usually at that point, right? You normally have your stop loss there, but you've removed it, and then it shoots all the way down. It shoots all the way down. At that point, you're looking, hey, can I look to buy? You'd buy, you look to buy 2 here, because you're thinking that it's going to bounce back up and break above that level. Doesn't happen. It turns down further, finds a bit of a support there, and then in this case you buy 4, because you did 1, 2, 4, and then it goes up, not enough for you to break even on all your those 2 previous trades, and then it drops further again. So what happens is that at that point you'll be looking to buy 8, right? And you can see that in this move, price actually went down by, we all know what Bitcoin went down by, that 41,000 big move towards the downside, right? All the way down from 22,550 all the way to 18,400, big move, 18% towards the downside. Imagine the psychology, imagine the emotions as you see your trades, not just 18% because it's 18, and then that's 2 lots towards the downside, that's another 20% towards the downside, and then that 4 lots again towards the downside, another 20%, and then that buy there, right? At 8 lots buying, you're sitting there waiting for this to push back up. I think the halfway point would be about that point there. So what you're waiting for is, since the 13th of September, as it drops, you're waiting all the way until that point. So take that away, possibly at this level here, you'll be looking to close out all your trades on a break even level, right? So all the way to the 27th of September, you've gone through that big loss, the big stress and worry, and then you see price now coming back towards break even as you close out the trade. Not worth, I think, as Simon was saying, not worth that heartache. I would rather take a stop loss, right? Hit a stop loss there as it breaks down. So realize that it's a downtrend. Look to sell it down as it hits the level and turn down and keep selling it back down again. Okay, and then lucky last is the other scenario where we actually see price pushing towards upside. So the reverse martingale strategy is when we look to, as it hits the level and bounce up, breaks above that point, we look to buy, right? As it breaks above a bit of a resistance level, we buy. It comes up, you can see a previous swing level there. As it breaks above that, you can buy again, not at the same number or double, you're looking buying half, so 0.5 lots, and then you can see that the next level there, oops, hang on, something happened. Okay, the next level, the next swing level there, you'll be looking to keep that away for now. Buy again as it breaks out of that resistance level at a 0.25. And in this scenario, every trade that you entered is in the money, stop loss being moved up towards break even, towards securing the level, moving it up all the way until it comes back down. So this one might have moved up, it comes back down, all your stop losses for the 3 trades would be below that support level, or as it moves up, you'll be at break even there. You would have secured profits for 1 standard lot, secured profits for 0.5, and a break even at a 0.25, which you would be looking at minimally about a big move, about 12.9% move towards the upside on just based on the first trade there. All right, so quite fortunate in this case, especially for volatile markets. Just zoom in out a little bit. You can see that we have opportunities to stack or to do a reverse martingale to keep adding on trades in favor of you. All right. In the unfortunate scenario, you'll be looking to enter trades against you as it drops. Then you'll be looking to keep buying as it drops towards the downside, only for it to recover later into the month. All right. And then also where it works better in terms of martingale is when prices are trading in a range. If you make a mistake buying at the top of the range, you could hedge it, or rather do a martingale as it drops down. You look to buy the support to push it back up again, or to wait for it to bounce back up again. Right? So when it ranges, it's quicker to recover compared to when it's in a big trending down scenario. With that said, how did you do you think you guys would deploy the martingale strategy? Or will you continue, if you are using it already, will you continue doing it, or is this something that you would use only as a recovery method, or would this be something that you would understand, think about, but probably not look to get into? It is the bad habit. It is a bit of a bad habit, a bit of a way to rescue a bad habit, but I think the safer way will be to avoid having that bad habit, or just realizing, understanding that you have to realize the loss sometimes. Good stuff, John. I do love that reverse strategy, or the reverse martingale. Consider it, stop loss taken, lesson learned, move on to a better trade. I love it. Exactly, Simon, exactly. All right, so if you guys had a good session, let me know. Let me know if you had a good session. If not, let me know if there's anything else I can do. Any feedback, I'll be happy with that as well. Thank you, Alan. And if you have any questions on the martingale or any other analysis that I provide, put it into the chats. Reach out to me, let me know. I'll be happy to help you and guide you through your trading journey. With that, thank you, Akimi and Jamilu. I will, Desiree will take it offline. I'll help you with the grid system as well. All right. So with that, take care now. Trade well, trade safe. Remember, guys, Kiwi dollar, Reserve Bank of New Zealand with the interest rate decision tomorrow. So just be extra careful early in the morning tomorrow for that. Okay. I do think that we're looking to drop again. So if you want to consider a possible, do some analysis, Kiwi dollar might drop. Again, disclaimer applies. All right. With that, trade well, trade safe. Take care now. Bye-bye.